China's financial system is on the brink of collapse as home sales plunge. I'm your host, Steve Van Metre, and thanks for joining me today. And just when you thought things in China were starting to turn around, they've gone from bad to worse as the financial system is under attack again, and at the worst possible time as the global economy is slowing down. Let's over to Wall Street Journal, where we picked today's story up as China home sales plunge in July as mortgage revolt deters buyers. Sales at the country's top 100 property developers fell a whopping 39.7% in July from the same period last year to the equivalent of $77.6 billion. According to data released on Sunday, July sales were down 28.6% from June, ending a two-month recovery in month-to-month sales growth. China's private sector property developers went on a years-long debt-fueled building boom, selling homes before they were built until a funding crisis that began last year led to defaults in stalled projects. Buyers who typically sink large down payments into those homes have been venting their frustrations all summer. And home buyers, some waving signs saying construction stops and mortgage stops, say the threat to halt payments is the only way to get their voices heard as projects stall and delivery times drag out. A broadly slowing economy that is biting into employment and incomes is adding to the pressure, with some buyers saying they are increasingly unwilling to keep paying for a home they aren't sure they'll actually get. And that's the issue here in China, and why this is such a big story is because on one end you have developers selling homes that are unfinished, and on the other side you have people buying those homes, actually paying them, closing escrow on them, and they're not done. Now in other parts of the world, people usually don't buy things until they're completed. In this case, you have cash-strapped developers running out of money, and on the other side you have a slowing global economy and buyers saying, look, we're not going to keep paying. If buyers win out here and those developers fail, there goes China's whole entire banking system, because housing's a big part of it. And pressure is on the government is building, but hopes for a large real estate rescue package from Beijing remains unrealized. The Politburo, China's top policy-making body, made clear recently that local governments are ultimately responsible for fixing the property woes in their market. But the sector won't stabilize if developers' liquidity crunch is not relieved, and that is a big issue, because looking at the banks, they now may face $350 billion in losses from the property crisis alone. And there's the problem. You have the banks stuck in the middle. You have cash-strapped developers and unhappy consumers, and in the middle, the banks are sitting there, and the developers say, we need money. And of course, the banks know this is effectively a big Ponzi scheme. If they don't give the developers money, well, they're going to fail anyways. If they give them money, they're not sure they're going to finish. It is a horrible story that does not end well for China. As mortgage boycotts and slowing growth are rattling authorities, and pressure is seen growing on China's $56 trillion banking system. In a worst-case scenario, S&P Global Ratings estimated that 2.4 trillion yuan, or about $356 billion, or 6.4% of mortgages are at risk, while Deutsche Bank is warning that at least 7% of home loans are in danger. And so far, listed banks have reported just 2.1 billion yuan in delinquent mortgages as directly affected by the boycotts. But banks are caught in the middle, and if they don't help developers finish the projects, they would end up losing much more. And if they do, that of course would make the government happy, but they add more to their exposure to delayed real estate projects, particularly if some of these deals don't actually go through. Maybe people just walk away from their loans because the economy is slowing, and now you see that how bad the situation can get there. And it's already bad now. It's only a question is, if the global economy continues to slow, it's going to get a whole heck of a lot worse. The real estate market is the ultimate foundation for financial stability in China, and that is key. Disposable income growth is slowing, further hurting the ability of homebuyers to service their debt, as China's home price weakness has spread to 48 of 70 major cities in June, up from 20 in January. And so there you see it. The consumers are looking at this as their disposable income goes down due to inflation, that they may not be able to afford these homes they bought or that they want to buy, and that will end up tanking the housing market. So you can see China's banking system is being hit with a double whammy from the developers and the consumers. But there's one thing that shouldn't take a double whammy if the global economy comes crashing down, and that's your portfolio. I'll put a link up here to Portfolio Shield and in the description below. Well, only strategies out there that can hedge with bonds. As you're about to see, interest rates are going to head down as the global economy slows. Let's continue on with today's story, because world factory outlook darkens and at a bad time for China as it's seen weakening from Europe all the way over through Asia. And purchasing managers indices, these are surveys for the euro area's 4 largest members, all indicated a contraction, with shrinking confirmed for the region as a whole after an initial estimate on July 22nd. In Asia, it was China, South Korea, and Taiwan that took the biggest hit. The Eurozone manufacturing is sinking into an increasingly steep downturn, adding to the region's recession risk. New orders are already falling at a pace which, excluding pandemic lockdown months, is the sharpest since the debt crisis in 2012 and the worst likely to come. And that's the key, is new orders are a leading indicator. If they're crashing, everything is going to come following it down, and that is bad news. And you'll see in a little bit just how bad that could be. In Asia, data showed that China's factory activity unexpectedly contracted in July, reversing earlier economic momentum as sporadic COVID-19 outbreaks weigh on the recovery. The official manufacturing Purchasing Managers Index fell to 49 from 50.2 in June. Keep in mind, 50 is unchanged, so 49 is a slight contraction, which compares to 50.3 median estimate in a Bloomberg survey of economists. And so what you're seeing here is the economy is like a pendulum. It just swung out. And remember, we've talked about this on the show, that it just reaches a stall speed at some point, and then all of a sudden momentum starts to shift the other way. We talked about last month how we were getting right near that apex, and now we're starting to see, again, it start to shift the other way. And when it does, it will go quick. Let's continue on, because these reports reflect the darkening outlook for the world economy that forced the International Monetary Fund last week to lower its global growth forecast for this year and next, warning an outright recession may be just around the corner. So now when you think about the China housing situation, what if all these people who bought houses can't afford them because the world then goes into a recession, and whether they want to buy them or not, or maybe they have bought them, they just can't afford it, so they stop payment. You can see the bankies there are already on the brink as the developers are nearly insolvent, but wait till consumers are there too, and then there's nothing stopping the downturn, because the U.S., if you think they're an island away from all of this, well, we're not. We're on the brink as well as seeing our manufacturing sector start to shift the other direction. Today we had the ISM official, and say official, it's not a government statistic, but it's considered the official standard of the manufacturing PMI at 52.8, and that's slowing down a little bit. So you're seeing that pendulum start to slow down. And look at this, new orders and employment are contracting. Production and backlogs are growing, but that's a good sign. Supplier deliveries are slowing at a slower rate. Raw material inventories are growing. That is not what you want to see in an inflationary environment. That's disinflationary. Customers say their inventories are too low, which is still shocking to even see, because we're seeing quite the opposite, and prices are increasing at a slower rate. And that is one of the key things I want to focus on, is prices paid, because this is also telling us that inflation is coming down and that interest rates are coming down. And I want you to see this because it really makes a big difference as people, including the Fed. And keep in mind, the Fed is thinking that inflation is going to stay hot for a long time. And our own chief strategist, Jeff Snyder, says something by the end of the year changes and inflation is going to come down and the Fed's going to reverse policy. Well, let's take a look at this data and maybe you'll see why he's got that view. And when you look at the current prices paid for the Philly Fed, this is a Fed survey, so I don't have the ISM data available in the Fed database, against 30-year Treasury yields. And what you see is as prices paid here in blue peak, notice it signals a peak in interest rates or a near-term peak. So here you see peak in prices paid, a peak in yields forming. Here, prices paid is peaking. You see yields starting to peak. Same thing here. Same thing again. There's a little spot here that I didn't mark. This spot before the great financial crisis. You see another peak and interest rates are rolling over. And what it tells us now is this peak in prices paid is an indicator that interest rates are likely peaking out here, or maybe soon to peak, and then they're going to head lower. Doesn't mean they're going to rapidly fall right away. It just means that they're probably going to start heading down, and that's a symptom of tight financial conditions. Now let's take a look at what that means for the consumer price index, because when we take that same Philly Fed prices paid data and we overlay the consumer price index in red on a year-over-year rate of change, and notably look, you can see prices paid lead the consumer price index. And so what that tells us is something, and we don't know what it is, but we already know the global economy is slowing, and that means inflation is going to come down. And of course, now we'll look to our chief strategist, Jeff Snyder, who writes in his daily about the cure for rate hike fever, as he says central banks remain publicly very aggressive. Their collective policy focus tilted decidedly in favor of inflation risks, as dozens of central banks all around the world have begun or have been raising policy benchmarks, and while doing so signaled their determination for going much further. But he said the tide may have turned toward recession and inflation fears as bond markets again trade in their own globally synchronized fashion. They've only pushed rates lower, including those in Japan, while here in the U.S., U.S. Treasury bill rates are now below the reverse repo rate, which is staggering. And there may not be much more left from the FOMC either, he says, but what you can see by this prices paid data, inflation is coming down, the global economy is slowing, and this is not good news. And of course, for China's property market, it could mean their entire banking system comes crumbling down. At the same time, the entire U.S. economy is slowing. If you want to get Jeff's research and mine, there's a link in the description below for Markets Insider Pro. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.